Thanks everybody for joining us on the Spartan Storage Fund webinar. This is our August update, and we're going to go ahead and walk through how the fund is doing, the asset that we've already purchased for the fund, and then we're going to talk about the remainder of the assets that we're going to buy in the fund. And so we're going to dive in deep to that tonight, and we're going to talk about all the different deals that we're going to do inside the fund and give you a complete update on the purchases that we've already made. So thanks for joining. My name is Ryan Gibson, and this is our fund update for August. We're going to go ahead and get started. Want to just thank everybody for joining tonight. My name is Ryan Gibson. We're going to go ahead and discuss Spartan Storage Fund 1 and the opportunity for funding that we're opening up for our third and likely our final tranche of the fund. And we're also going to talk about the performance of the fund tonight. We're also going to walk through how well just our team is doing on the assets that we've already purchased and the hard work that our acquisitions team is doing in finding new amazing opportunities inside of the fund. So we'll go ahead and get our disclaimers out of the way. We're not offering any legal advice. Please do your own due diligence, and please read all offering docs in the deal room that we provide, and consult your tax and legal team before making any decisions on investing in the fund. And obviously, this is just a general overview. If you want to look at our due diligence, our feasibility, our underwriting files, all of those can be found inside of our investor deal room, where you can see all of the underwriting and financials that support our investment into the fund. So tonight, my name is Ryan Gibson, but I'd like to just introduce the executive team here at Spartan. Scott Lewis, our Chief Executive Officer. I'm Ryan Gibson, our Chief Investment Officer. And then lastly, we have Ben Lapidus, our CFO, our Chief Financial Officer. And just to talk about Spartan really quick in general, we have quite a track record. Those are the three companies. Spartan Investment Group is the main parent company, and we do all of our own Spartan construction management through building additional units and all of our improvements. And then we also have our FreeUp storage company that does all of our property management. We've been doing property management for years. Our first property that we purchased, and to the last property that we purchased, we manage all of our assets under our FreeUp Storage national brand. So a little bit about Spartan. We've raised about $200 million to date, and we've had over $15 million in investor profits paid out. We have about a $500 million storage portfolio, and we have 100 full-time employees. We just crossed the 100 mark a couple weeks ago. And we've been recognized by Inc. magazine for the last 3 years in a row as America's fastest private growing companies. And just this past year, we were 128 on that list of all 5,000 companies that made it to the top. So likely we are, or otherwise, we're also we're the top 40 operators as ranked by Inside Self Storage. So Inside Self Storage looks at the top 100 operators every year. And we moved up the list this year to number 40, which is fantastic. This is a list of where all of our properties are currently located. And then tonight, we're going to talk about the three kind of different transactions that make up the fund assets. One is Plaza Mini, which we've already closed on, and then the Horizon portfolio just outside of Louisville, Kentucky. And then we're going to talk about the Go Store It portfolio that is 7 assets spread across Kentucky, the Carolinas, and Florida. So why do we like storage in the first place? Well, we're going to get into this a little bit tonight, but it's recession resistant, meaning that during the last 4 downturns of real GDP growth, self-storage occupancy has been super strong. So it does really well during downturns. In fact, if you read our last blog, we studied the REIT data, and REIT NOI is up. Storage REIT NOI is up as much as 20% in Q2, and we just did our own personal round of rental increases across the portfolio of about 25%. So storage is booming. It continues to boom during the recession and does really, really well. And that's why we chose the asset class back in 2016. So the fund returns, we're targeting about 15 to 20% cash on cash return. This includes the upside from all of the sales of the assets, and it includes the cash flow along the way. And speaking of cash flow, we're projecting 5 to 8% per annum cash flow. Our first distribution for the fund is going to be on September 1st for those investors who have already invested. And then we also target a 13 to 18% IRR for the investments. And all that basically means is a 2x multiple over 5 years projected. So that means that if you put in 50K, you would get the 50K back plus $50,000 in profit on top of that. So that's the 1.7 to 2.2 multiple over a 4 to 6 year projected hold. So we've had a lot of questions about depreciation and what is my cash flow for the fund. And so basically, if you want to just take 30% of your assets or your investment, that's what the projected cash flow is for the fund. So for example, if you put in $1 million, your first year projected tax loss would be about $300,000 per $1 million invested. So what that means is the first 4 years of the fund, we're projecting about $280,000 of cash flow. So that would mean on $1 million investment. So that would mean in the first year, you would shield that taxable income. Second year, third year, and even the fourth year, you would have enough depreciation to cover the gains. Now, as always, I'm not a tax attorney or a CPA, so always do your own due diligence on this. This is just a projection. So secondly, let's talk about risk mitigation inside the fund. So right now we're in a time where the economy is uncertain. We have high inflation, we have rising interest rates, we have lots of changes going on in the environment, but our risk mitigation strategy is self-storage. It's a recession-resistant asset class, which is why we chose it many years ago and have stuck to this asset class as a strategy. But inside the fund, and what we're doing today specifically, is we're looking at slowing down acquisitions. So these are probably the last few assets that we're going to buy into the fund, and we're expecting the fund to completely close up in September and terminate. So we're planning on buying the last few assets and then closing down the fund. And the reason why is because we've looked even harder for good deals, off-market properties. We've negotiated with our sellers, and we're just purchasing less. We're taking a little more conservative approach to what we've been buying and how fast we've been moving. So we're purchasing less inside the fund. The other thing that we do across all of our assets, so every single property that we buy, we put through a 700-point due diligence checklist. So when we talk about the 10 assets tonight that we're buying in the fund, that represents 7,000 lines that we've gone through on every single asset. We put that through our due diligence checklist on every one. We also share that. And speaking of which, we share the underwriting for each investment in the deal room on the dashboard. So we'll share the full underwriting file, and we share all of the planning for raising rents and our sources and uses and all that stuff inside of the fund. And speaking of which, when we're underwriting the finances, we are underwriting for the worst case predictive yield curve. So we're expecting rates to go up, and we're underwriting that as such, and we're projecting to have a higher interest rate environment, and we're packaging that into our underwriting to hit those projected returns for the fund. The other thing that we're doing on the capital market side is we're negotiating fixed rate loans. We don't want variable interest loans, and we're looking for loans that don't have a prepayment penalty, meaning that if interest rates go down in 12 months or 18 months, or they change drastically, we can refinance those loans or work with our current lenders on refinancing those loans, and we don't have to worry about a prepayment penalty. So we're working that out of all of our upcoming finances. The other thing that we've done on the assets that we talk about tonight, collectively across all things that we've had under contract, we've negotiated a $2.75 million price reduction across the fund assets. And the reality is interest rates are going up. And so we're negotiating a better price to purchase these properties because of that interest rate environment. We're not going to overpay. We're going to price these assets correctly. And if interest rates go down in the future, we're only going to benefit from it. But we're underwriting these correctly going in, and we're negotiating with the sellers to reduce prices commensurate with rising interest rate environment. And lastly, what's great is even though the recession is probably taking hold in the economy now, whether you think it is or not, we're having significant rent increases. So all these properties that we have under contract, rents are going up. So these assets are getting more valuable the longer it takes under contract. So that's a really good thing as well. All right, so let's talk about the just kind of high level, the 3 transactions in the fund tonight. So Plaza Mini Storage, which is now branded as FreeUp Storage Havelock, that's been closed. That was a $15 million purchase. We're buying a 2-pack in Louisville, Kentucky. And then we're also buying a 7-pack in the Go Store It portfolio across Kentucky, North Carolina, South Carolina, and Florida. And we're going to dive into each one of these properties into more detail, but you can see these are all mostly stabilized, rent growth potential, and really nice markets. I mean, for example, there's a property that has 8 times the population growth surrounding the facility. So we're going to dive into that one. We also have many assets in that portfolio where household income averages are over $100,000 across the portfolio. So we're really excited about the demographics and the population growth surrounding these facilities. So let's get right into it. So let's talk about the property that we purchased. So you notice we have a brand new FreeUp storage sign on it. We're already moving to rebrand and renovate those properties. And we've got boots on the ground already. We've already hired our store managers and we are off and running. So this is the first asset that went into the fund. And this gets me really excited. We closed on June 28th and we've already increased our street rate 75%. And we had over 29 new tenants move in at that higher rate. So we are absolutely just increasing revenue. In fact, we increased revenue 29% in the first month. So when you look at, I think revenue was about $92,000 when we took it over, and now it's over $120,000 per month. So we're increasing revenue substantially, and we have even more revenue increases planned for when we raise rents in October. And we're waiting till October to raise rents. We just took over the facility. Part of the reasons why we have to wait is because we're on an annual lease, annual leases with our clients or with our customers. So we're going to have substantial increases in October and continue to increase NOI and value of the property. We also put tenant insurance on all of our, we require tenant insurance of all of our customers. They don't have to use ours, but if they do, we get the profit. And if you've invested with us before, you can see in our rent rolls, we charge anywhere between $9 and $18 per month for every single customer. And we haven't rolled those tenant insurance premiums out yet, which is going to be a great revenue booster. And we're anticipating for those that invested in the fund prior to that date, we're going to have our first distribution on September 1st. And we're still calculating exactly what that's going to be, but likely to be right around our cash flow target for the first year in the fund. And this property was not financed. We paid all cash for the property. And right now we're working on getting the correct terms and getting a really good rate in terms for this refinance. And again, we bought this property with the rents 51% below market. So we're going to add a ton of value just by increasing our rental rates or our collections as we refer to it. So that is going to add a lot of value, and we have a lot of room to grow, and the facility is really well occupied at above 95%. So let's talk about the upcoming purchases for the fund. I'm going to go right into one of my favorite ones in that 7-pack, which is Bonita Springs, Florida. And this is kind of like if you've invested before in the Cumberland deal or the Heartland opportunity. This is just as that classic 3-story climate-controlled, high-demand facility in a great market like Bonita Springs, Florida, where it's the 4th fastest growing county in Florida. Specifically, the average household income within a mile is over $140,000 per year. And this is basically a trophy asset, which has got really good positioning on the main street. So it's got really great street frontage, over 40,000 cars that drive by a day. And there's over 1,400 residential units that are being built within a 5-mile drive time of this property. So when you talk about a rising tide market, this is exactly how it's defined. Now, we already have a lender lined up for this. We have a locked-in interest rate. It's a fixed rate. We have an interest-only period, and then it rolls to a 25-year amortizing loan. So we're not using acquisition debt for any of these properties that we list the term sheets on. So we're buying these at locked-in interest rates and really great IO and 25-year AM rates, especially with this property. So, and the way the story here is the rents are below market. So specifically on this property, the rents are 10% below market, but the market's 95% plus full. And so they're just really not pushing rental rates or collections like they should. And I think that's basically what we're going to do as part of our value add strategy in this asset. So high quality asset, great market. Now, if you could pick anywhere else in the United States to invest, you'd go straight to the Carolinas. Which is the population growth is the rising tide, like I said earlier, that raises all boats. And we're going to just go right into our next property, which is in Raleigh. And this facility They say kind of Raleigh is sort of the next Nashville. There's over 650,000 people that are planning to move to Raleigh, or they project to move to Raleigh over the next 5 to 10 years, which is incredible. And this property has 6 times the national population growth rate within a 5-mile radius, which is incredible. And it's less than 15 minutes from Research Triangle Park. If you're familiar with that, that's one of the largest, the country's most successful research parks. It's home to Google, Amazon, Apple, Dell, IBM, Pfizer, just to name a few. And Apple actually specifically is renovating a campus within 10 minutes of this facility, a $1 billion campus. And there's over 24,000 cars that drive by this facility every day. And if that's not enough, we have 7,800 new residential units being built within the 5-minute drive time. And these are smaller apartment dweller units that are going to need self-storage. And this facility is well over 90% occupied with really high occupancy in the market, 95% plus. So with this one, we have 9% below market rents. We have a very well physical occupancy here. So we're planning to raise the rates and the rents to push the collections and the NOI on this asset. Moving right over to Wilmington, North Carolina. This facility is one of the best occupied inside the 7-pack, 97% full. And because this facility is on that Market Street, which is the main street, it's really a strategic location that's located in the prime retail corridor. And what's great is that 29,000 cars that drive by this facility every day. The demographics are super strong with income over $140,000 per year within the 1-minute radius, 1-minute drive time. And we've noticed that, basically a lot of people are moving to markets like Wilmington and coastal communities because during the COVID-19 pandemic, people moved here in droves because these smaller towns are now set up for professional services. And they're now living in what used to be tourist towns, beautiful areas, but now they're getting a lot of population inflows that can work remotely. So one of the reasons why Wilmington continues to boom is that reason, and over 10,000 new units are planned around this facility over the next few years. So this one does have a locked up loan on it, 6.35% fixed interest rate, 18 months of interest only, and then that rolls to a 20-year amortization schedule. And again, this one, like the others, 10% below market rent. So we plan to push the collections on the current customers just to bring them up to where the market is. We're not even talking about pushing market rents. We're talking about just bringing them up to where they need to be. Moving over to one of my favorite places to go vacation, which is in Bluffton, South Carolina. Not Bluffton, but it's right next to Hilton Head Island, which is a heavy tourist destination. The population in Bluffton has nearly doubled since 2010. So population growth is more than 4 times the national average surrounding this property. And what's great is that there's 17,000 new residential units coming in within the 5-mile ring. So really good market here. And the units are basically the average income here is exceeding $120,000 per year within a mile. And really this property has a lot of value add potential just by fixing it up. It's just a little rundown. But they're still well occupied, over 90% occupied. The market's well occupied. And this is kind of the first facility you get to when you leave Hilton Head. So it's kind of a value proposition from that perspective. Like I said, we're gonna improve the facility quality. And this one also has a loan locked up, ready to go, 6.45% fixed rate. This has got a 12-month IO period, and then it rolls to a 25-year amortization on the loan schedule. This facility has 11.4% below market rents. So again, really good opportunity to fix this property up and raise collections. Moving to Greenville, South Carolina. This is known as the #1 go-to logistics hub in the United States. And the population growth here has been 4 times the national average. Again, this property, well located. You can see the road that's just that goes kind of east-west on the top of the screen there. And then the highway there. So it's anchored by 17,000 vehicles per day on the front, on the top side there, and then going north-south as 130,000 vehicles per day. So this has got great visibility from the main road, which is one of the huge drivers in self-storage. But what I love most about this property is there is about the household incomes are over $100,000 per year, which is fantastic. But there's 3,900 new residential units coming in within the 5-minute drive time. Again, these are smaller multifamily residential units that are going to need self-storage. And the other exciting news is Lockheed Martin just awarded a $900 million contract in the area within, I think, 15-minute drive time from the Air Force. And so that's a $900 million contract that's going to bring even more jobs and more growth to this area. So Greenville location just really well positioned for continued growth. Not surprisingly, we've already got the debt lined up on this one, 6.35% fixed interest rate, 18 months IO with a 20-year amortization. And the rents here are 14% below market. So we see a lot of value add potential in this property. Next facility is in Fletcher, North Carolina. This one is just south of Asheville, North Carolina, which I'm sure everybody's familiar with Asheville. It's a booming town, really cool place to go and hang. This property is just right off the main road of Fletcher, which doesn't get a ton of drive-by cars, but the reality is it's well located on the main road that goes through Fletcher. And it's got really strong occupancy. And our plan here is to really take advantage of the under-market rents and drive collections. And for a town of over 50,000 people within a 5-minute drive time, this is still a 5-minute ring. This is really strong population for the town size and location. And there's about 14% below market rents on this facility as well, just like the Greenville property. So we have a big opportunity here just to simply do light value add in the sense that we can bring the rents to market whatever other facilities are charging in a market that's really well occupied. And so lastly, this is probably one of my top ones as well, for a number of different reasons. We're closing 3 facilities in Louisville over the next 2 months. So in September 7th, we're planning to close the 2 Horizon assets that are just 30 minutes east of Louisville. And this one is 30 minutes from those properties. So we're going to have the fund itself is going to have a great economies of scale in Louisville. So what's the big attraction in Louisville? What's the big deal there? Well, it's interesting. Louisville is located within a 2-hour flight of 70% of the U.S. population. So it's no wonder why the UPS put their world global headquarters there, because they wanted to be strategically positioned to reach a majority of the United States within a short flight. There's over 2,200 residential units going within a 5-minute drive time. So it's really nice population and income growth. Average income's over $110,000 per year. And but the best part, 8 times the national population growth within a 5-minute drive time of this property. So the population around the property, the population in Louisville is just absolutely growing. And the income growth is over 2 times the national average. So what we like is now that we have 3 in Louisville, we're going to have really good portfolio composition, making the sale of this asset extremely flexible. A lot of the bigger buyers want to have multiple assets in a market so they don't have to hire one manager for one location. They like to kind of scoop them all up and buy more facilities at a time, especially at this size, 41,000 and greater on all 3 of these facilities that we're going to talk about. Not surprisingly, again, we have really attractive rates, 5.36% interest, fixed rate interest for this property. It's 9 months of IO, 25-year amortization after that. And the bank that's lending on this property is also lending on the other 2 properties in Louisville. And they're super bullish on storage. In fact, I might talk about this a little bit more, but the next 2 properties that I'm going to show in Louisville, the lender stayed in place. So the previous seller was selling the property, and that lender is just continuing to stay with these properties because they love storage, they trust, and they know the asset. So they're just kind of rewriting a new loan for us on these facilities. So the last 2 in Louisville, Shelbyville, we're closing this asset on September 7th. And this property surrounding it, they have the 4 times the national growth, and it's in a very affluent area with 10% below market rents. And we're going to drive value on this facility by converting 4,400 square feet of warehouse space and really kind of driving NOI at that higher rent premiums that we'll get from that. This is located about 7 miles from the Simpsonville location, which we're going to talk about next. And it's about 17 minutes from the previous Louisville location that I talked about. So there'll be 3 in Louisville, creating that efficiency. This one, we locked up the interest rate with German American Bank a little bit sooner. So this one was 5.26% fixed, 9 months interest only, 25-year AM. And again, this is the same lender that's doing the other Louisville properties. And the rents are 10% below the market. Simpsonville, one of the good ones in Louisville as well, closing 9/7. Again, that's the same transaction. There is absolutely no competition within 5 miles. So when you talk about why we like self-storage or what self-storage facilities we like the most is when there's not competition. And so this one has a donut hole of no competition surrounding it, which is absolutely fantastic. This facility, again, has 4 times the national population growth rate surrounding it. And there's an opportunity to increase revenue because the seller of this facility built it only a couple of years ago. And the plan is to just finish the lease up and then bring those rents up to where the market expects. And we believe that it's about 10% below the market now. Again, we already have the loan lined up. We already have a fixed interest rate, 5.26%. The bank has been banging down our door to get this closed. This got a little bit behind our closing schedule just because we had some things that we had to work through in due diligence that our due diligence process caught, but that has all been resolved. And now we have a closing date of 9/7. So just kind of wrapping things up, just talking about the fund, why we like the fund is that, now that you have a really good idea of all the assets that are in the fund, you can see that we can spread out risk between multiple high growth cities. And we can get assets that some don't have any leverage, some have better leverage than others, but you can spread out the risk so you're not getting the peaks and the valleys of an investment. So which is really nice. Get better exposure to those markets. And we believe that this delivers the potential for higher returns. So what's our exit strategy? People always ask, what is our plan? And it really is the same in every deal. And that is, it can be summarized in one word, and that's optionality. So our plan is to buy assets and have a business plan that we can complete so that we can sell these facilities for a profit, right? But we want to have optionality. If we stick to just one strategy, there's a high likelihood that won't work. So what's great about our potential optionality is we could break up these properties into multiple sales. Right now, we're actually selling 2 of our facilities inside of a portfolio for a really great price. And we just decided, you know what, we don't like these 2 assets, or it doesn't really fit our portfolio composition. So we're going to sell them. So we've done individual sales, or we can break it up into multiple portfolio sales. We can exit our entire portfolio to a REIT, or maybe a bigger buyer, an institutional buyer. And then again, like I said earlier, we can sell properties individually. So how does the fund work? So some investors have already invested. They're going to benefit from the distribution that's coming up in a couple of weeks. For new investors that invest in the fund, your funds, once received and deployed 100%, we deploy them throughout the entire portfolio. So you take advantage of all of the great opportunities, investments, facilities that we just talked about. It's not just one. You get the benefit of all of those properties. And then we expect the first distribution to happen about 3 months after your funds go active. So about a quarter after your funds going active in the fund. And if you invested now, your funds would likely go active at the beginning of September. So the next steps for the fund, you can sign up on our website, Spartan-investors.com. You can see here that you can log into our investor dashboard. There's a little circle there at the top. That's our website. And you can see there's a portal login. But if you have any questions about anything, just call us, or you can email us, investors@Spartan-investors.com. We'll get you set up on the dashboard and make it really easy to subscribe and invest. And at this time, we're going to go ahead and open it up for Q&A. And we're going to do a Q&A session. So if you do have any questions, put them in the chat window, or you can put them in the Q&A box, and we can answer a few questions live tonight. And for now, we're going to just kind of go over a couple of frequently asked questions. And the first one that we get a lot is, do investors receive the benefit of one specific property or all properties in the fund? And the answer is investors benefit from all of assets purchased by the fund. One question that we get a lot is, do investors receive the benefit of bonus depreciation or depreciation in general? And the answer is yes. Our investors get the benefit of bonus depreciation, and we get a K1 that comes out to you by the end of March every year. We really stick to that. So typically our depreciation is about 30% of your investment amount. And we do a full cost segregation bonus depreciation study. Obviously, as you know, 2022 is the last year you can get 100% bonus depreciation, and then it reduces it by about 20% thereafter. But you do benefit from bonus depreciation. So your funds, so the next question that I have, we're going to go ahead and just go to the live Q&A. But if you have any questions after this, you can email investors@spartan-investors.com. But the first question we have is, how do I know my funds go active? Great question. If you go onto the investor dashboard, when your funds are active, we'll present them as being active. So if you've invested prior to about July 1st of this year, your funds are active, and on your dashboard, it'll say funds active. It'll actually delineate that and say that your funds are active. We also will email you and we'll tell you that your funds have gone active in our regular update. So we'll say, hey, if anybody who invested before this date, your funds are active. And if you're not sure, you can email us and we'll tell you if your funds have gone active or not, but otherwise on the dashboard. Ryan, I'm familiar with many of the markets you've invested in. Bravo. Yeah, thank you. A lot of really good markets. I'm excited about, especially the Raleigh market. Do you think self-storage is currently overvalued? That really depends on the situation, depends on where you're buying. It depends on the specifics. The first property that we bought into the fund, we paid 40% below market value. So what we looked at is all the comparable sales in the market, and the most recent gave us an indication that we paid 40% below the most recent transaction for a comparable asset type. So self-storage as an industry or in general may or may not be overvalued. It might, some assets might be, some assets might not be. Really just a matter of perspective on what you can add in value. But what we're finding is deep relationships and off-market deals are getting us great discounts when we buy. How long does it take for funds to go active? 3 months typically. However, we're kind of in this unique window where we're just about to open the third tranche, and your funds will go active if you invest in the next week or so, right away. September 7th, I should say. So pretty quickly, so only a couple of weeks at this point in time. All right, so I don't see, okay, yeah, the difference between Class A and Class B shares is we're giving a bump, an ownership bump for those that invest more, so $1 million or more. So if you're a fund-to-fund or if you're a larger check writer, we're going to give you a higher return. I believe it's 20% ownership per share more if you invest $1 million or more, and then as opposed to a Class A investor who invests $50,000 gets still a great return, but just a little bit less. Great. So just kind of wrapping things up here, we're expecting the fund to close in September. So if you're thinking about doing the fund, we're planning on wrapping up our acquisitions into the fund for the remainder of 2022 very soon. And so this presentation gives you a great analysis of all the properties that will be inside the fund. And if you have any questions, reach out to us. And we want to just thank everybody for attending today. And we hope you join us in the fund. Have a great day, everybody. Thank you.